So file this under finger on the pulse, right? The SFR industry, we're in the thick of it every day. And I try to share when something I think noteworthy happens. And this is September 4th, 2020. And just yesterday, we got reports from the field that builders were showing signs of anxiety, were the exact words. One of our agents reported back. Builders up in the Pacific Northwest were anxious. I said, interesting. Why are they anxious? Because what was a raging summer all of a sudden slowed down. The buyer activity that was over the top in June and July slowed down a little bit, maybe just a little bit. But when that person said that, Josh up in Seattle said that, some heads started nodding, and I asked around, and other people in other parts of the country were saying that builders they had spoken to 3 or 4 weeks ago who said, we don't need to sell properties to investors, right? That's what we're talking to builders about, selling new homes to investors. And they were all nodded and said, yeah, we're sensing some of those builders that said 3 weeks ago, I don't need your help, are now all of a sudden receptive. Okay, so their traffic is slowing down. Now, what does that mean? Take you back to March and April, COVID first started. The question was, okay, we had this hyper fast recession. Stock market tanks on Monday, unemployment spikes on Wednesday, real estate market freezes up by the following week, right? It was so fast that we posited the concept that if a recession and a recovery are two chapters in the same story, right? And if the characteristics of a recession often follow through to the characteristics of the recovery. And in this case, the main characteristic of this recession was speed and severity, just off the cliff, right? So if the speed and severity, well, that's what actually happened. Stock market's back close to highs, and the real estate market went crazy over the summer. I have friends that run regional real estate companies around the country. They say that they sold more houses in June than ever. Okay, we've got home builder clients that also reported the same thing, more houses than ever. What happens next when you have an extreme seller's market, which is what we've had? Okay, seller's market. There's very little inventory. Sellers are the kings and queens. The buyers are rabid. They're driving prices up. They're getting to bidding wars, and the sellers are in the power position. What happens next, usually a year later, is that the buyers get fed up with that. The buyer demand tapers off, and the sellers have to get more realistic, and that pendulum that swung up and stuck in a seller's market begins to swing back down again. I'm sensing that the pendulum is actually already swinging. Okay, I'm sensing that this fall we're going to see inventory up again. All right, so you're going to see inventory accumulating. You're going to see home sales slowing down. The rush to get out of the cities, the rush to people's impulsiveness to get away from COVID. Okay, like get me out of here. We have people renting houses that sight unseen. Okay, get me out of here. That get me out of here is slowing down as the cases slow down, as the COVID fog kind of clears. I think it's going to slow down. So I think we're seeing the very, very first signs of sellers. In the case of builders, they are sellers, and they see traffic coming in, and that the traffic is beginning to slow down. They're getting nervous. I think we could actually see that play out in a more even market in the second, the third and fourth quarter of this year, which I think is fine. It'll be reported naturally as the housing market is going into a slump. That's what the reporters will say, because they'll say anything to get a headline read. I'm not worried about it. I think it's good. I think an extreme seller's market is not what we want. An extreme buyer's market is not what we want. We want something in the middle, and that's where I think we're headed right now. I can tell you that strategists who look at data all the time, there's a lot of people that are smothered in data. Okay, these are guys, they're Wall Street type analysts that work in these large funds that are trying to gather intel, and they love talking to people like us because they can get the anecdotal intel that makes sense of the data. That's the point. Data, I see people misanalyze data all the time. Here's my favorite. It came up again this week. My favorite misanalysis by very smart, well-trained data junkies is when they look at a neighborhood and they want to see what the rental market is in a local neighborhood, but there's no rentals. They can't find any comparable rentals. There's nothing for rent. Nothing has rented. They can't find anything. They conclude almost universally that there's no rental demand in that market. Incorrect conclusion. The conclusion is there's no rental supply in that market. If you deem a neighborhood has no rental demand, you don't buy a rental home in that neighborhood. But when you see no rentals, that's because nobody bought any rental homes in that neighborhood. Right. Or you see a place that you want to buy. Like whenever we find a neighborhood that we can't comp easily, it's like, let's figure out what that's going to rent for. But if you're if single family homes rent in this area for 1,500, but you're the only one in this neighborhood, and that neighborhood is good. Can you get 1,650? Well, if you're the only one, you can, right? So lack of supply, lack of evidence of a market usually means lack of supply, not lack of demand. And if you create some supply, the demand will gobble it up, because there's always demand to rent houses in decent neighborhoods, always.
It's going to sound kind of like a dumb question, but I just, anytime you talk about, I hear a lot of people talk about this is like, refinance the house and pull the money out. I get the basic concept, but I think there's just some details of it. Like, I don't know what parts of it are like what you can and can't do. Can you just explain what that means to refinance and pull money out?
Right. Sure. Okay. Sure. So let's imagine that you own us, make it simple. You own a house free and clear. Okay. No mortgage. It's worth $200,000. You can go out and get a mortgage on that house and take out, let's say, half. Okay. So you take $100,000 out of the house. You're going to have a monthly payment now that you didn't have before. So that's why I don't like maxing out mortgages. People that say you should take all the equity out, they're trying to put the pedal to the metal in a marathon. You don't need to. Okay. Taking half of it out, 60% of it out, you're going to have a payment. So obviously you need to know what that payment is, because your rent is going to have to pay that payment. Your tenants, make sure your tenants are good. If your tenants walk on you or don't pay the rent, you're still making the mortgage payment, or your credit's going to suffer. All right. So you're taking on an obligation, but now you have $100,000 to go and put down on another house, either buy another house for cash, or what's probably more likely is use that $100,000 to buy another $200,000 house and make it a 50% down payment. Now, why is that useful? Because now you've got two houses getting more valuable every year rather than just one. If you really think about it this way, it's going to be about even cash flow wise. If you have $200,000 and you're generating $1,000 a month in profit, those are actually real numbers. All right. I'll go from the top. $200,000 house, you're renting it for $1,500 a month. You're paying $500 a month on your expenses, taxes, insurance, property management, maintenance. You're left with $1,000 a month. $12,000 a year is 6% of the $200,000 house. Okay. So you're making a 6% return, a 6% yield just on the cash flow. All right. If you went and bought two houses with that same $200,000, all right. So you put $100,000 on one, $100,000 on the other, you borrow $100 on both of them. Now you're still going to be making roughly 6% on your $200,000 because you got to pay the mortgages now. So you're still going to make only $1,000 a month in profit, because the $2,000 a month you were making in profit, $1,000 is going to pay mortgages, rough numbers. Okay. So by doubling the number of properties you own, you didn't increase your cash flow, but you increased your leverage, because now if that house becomes 5% more valuable, 200,000 is now worth 210. You made 10 grand, but if you have two houses, 200,000 became 210,000 in two different places. So you made 20 grand.
Whenever you still have a mortgage left and people refinance when they're still paying off their house, are you just refinancing the portion you have left?
Oh, okay. Yeah. So the main way that you do, there's two kinds of refinances. There's refinancing just to change your rate. Okay. They call it a rate and term refinance. So if I owe 150 grand on a $200,000 house, my rate is 5.5%. I could refinance it and just have a lower payment by getting a lower rate. Okay.
Gotcha.
A cash out refinance is what you're talking about, which is, in my example, I own a house that's worth 200. I have a $100,000 mortgage. I go borrow 150. I pay off the 100. So I have a new mortgage now for 150.
Gotcha.
Okay. My payment probably went up, but I got 50,000 in cash to go and make another investment with.
Gotcha.